Hi everyone, come on in, make yourself comfortable. We'll get started in about a minute or so, whilst I can see a few people joining us, so thanks for coming along. Hi everyone, we're just going to give people 30 more seconds to join in and get set up, and then we'll make a start. All right, we're on time, so we'll kick off. Welcome to this webinar on tackling the next investment challenges. My name is Jeff Thurecht. I'm a director of AFSL and Australian Advice Network. And I'm really excited today to be joined by Stephane Andre, principal from Alphinity Asset Management. So welcome and thanks for joining us, Stephane.
Thanks for having me, Jeff.
So Stephane and I have negotiated the latest COVID challenges to be coming to you from separate locations. So we hope you're also safe and well wherever you are. Before I tell you a little bit more about Stephane, I'd just like to let you know that during today's webinar, you'll be on mute, except for Stephane and I, and your video is off, so we can't see or hear you. We do encourage you to ask some questions though. So if you'd like to do that, click on the Q&A tab, which you'll find down the bottom of your screen, type those in, and we'll try to get to those questions on the way through. So also letting you know, most of our conversation today will be, sorry, I'm just getting a message through, just checking on that. Most of our conversations today will be about general investment strategies and the broader economic environment. So I'm going to let you know that, provide a general advice disclaimer and remind you that all that we're discussing today is general advice only, even though most of you in attendance are clients of Everlesco or Australian Advice Network. We don't know your personal circumstances at the moment, so this webinar is not personal advice. And if you would like to know more about what we discussed today, please contact your advisor or get in touch with me as well. So I'm going to tell you a little bit more about Stephane. Stephane is, as we said, principal of Alphinity Investment Management. His focus is on the energy, materials and utilities sector, as well as a portfolio management oversight. Stephane was previously a vice president and research analyst at for AllianceBernstein's Australian Equities Fund, covering the same sectors from 2005 to 2010. Prior to that, Stephane worked with, in management consulting with McKinsey & Company from 1997 to 2002 in South Africa and Australia. He also holds a commercial engineering degree with high honours from the top-rated University Catholique de Louvain in Belgium. Stephane is also fluent in French and German, and as you can tell, I'm not fluent in either of those languages by my pronunciation. Alphinity is a key manager in our AAN sustainable growth model, and as you now know, Stephane is well placed to look after our money. So thanks again for being here, Stephane.
Thanks for having me, Jeff. Yep.
So we're going to get started. Maybe to start off with, if you could tell us a little bit about Alphinity's background and the investment philosophy and how you're different to other managers.
Sure. Alphinity was founded in 2010 by 4 partners who had previously worked together at a previous firm since 2003. So we've been basically working together for close to 18 years, applying the same investment philosophy and process through that time. We've been backed by Challenger in 2010. Challenger owns 30% and 70% is owned by employees. Challenger provides the administration and the back office services, so that really allows us to focus on the investment side. With a bit of luck and a bit of skills from 2010, we've grown the fund under management today to close to 15 billion. We've expanded the range of products from covering not only Australia, but international or global products. and the team has with that extended from 5 people to now 16 people, with a dedicated Australian team, a dedicated global team, and also ESG specialist and client support specialists on our side. So that's been pretty interesting journey over the last 11 years.
Absolutely.
In terms of the philosophy that you asked, so the philosophy that we've been applying since 2003 and since 2010 at Alphinity is really, we are looking for companies which are quality companies, so very strong balance sheets, which obviously are undervalued, but that doesn't set us apart from the market. But what really sets us apart is that we're looking for companies which are undergoing a positive earnings revision cycle. And there are 2 beliefs behind that. The first one is that earnings drive share prices, and that makes obviously sense when you look at a DCF. It's a future cash flows, and if you think that the free cash flows are going to be higher than expected in the future, that means that the value of the company is going to be higher. So the first thing is earnings driving share prices, and the second thing is that we believe that the earnings are serially correlated. So when you have one earnings upgrade, you're more likely to have a second one. And again, that cycle goes on up until it breaks, but typically you have that serial correlation on the way up or down. And you can see that very strongly. For instance, take a company like Fortescue Metals. Since 2019, January, we have a series of upgrades. So we're really looking for companies which are entering that earnings upgrade. And so we need to see some momentum in these companies. So we're very focused on that with a strong sell discipline. We call it on the earnings investment clock of a company around 11 o'clock, where the valuation really gives us the time when we need to exit the stocks. And a bit more to say what differentiates us from other managers. We're completely style agnostic. We don't care if the market is a growth market or a value market, if the market goes up or down, because you can find these companies in these positive earnings revision cycles at any time of the market.
So how do you find those?
So yeah, so it's a mix of obviously strong fundamental research with a huge amount of analysis which goes behind the companies. We have close to 600, 700 interviews in the domestic market per annum, and with all companies being modeled. All of the analysts have been covering these companies for a long time, so we know them pretty well. But we also use quant signals, which we've been using since 2003. So there's 6 factors which help us to find companies which are likely to surprise positively. And what we find is when we have the combination of the quant and the fundamental research pointing to the same direction, the risk reward becomes actually really interesting. The information ratio of our fund is around 1.2 for the sustainable fund, which means that we're getting a very good reward for the risk we're taking. So we typically don't have this volatility in alpha of having 1 year of +8, +10%, in the next year of -5, -10. If we stick to the process, which we've managed to do, then we typically have this consistent alpha generation. Not huge numbers, but they accumulate over the years.
Okay, so alpha generation is just the outperformance to
that's correct, yeah,
the overall market. So that's where you're adding value on top of what the share market direction is providing by choosing the right companies.
Correct.
Yeah. So you talked about your exit discipline, which is great. So selling when the cycle gets to sort of 11 o'clock. When do you buy in? Do you wait to see one of those earning upgrades, or do you sort of try to get in before that happens because you're already talking to them, or how do you?
Yeah. No, whilst it sounds very compelling, and one believes that you'll get the biggest return when you manage to get to 6 o'clock, which is obviously what value funds try to do. Really getting it at the beginning of just before the earnings upgrades. We find it actually it's very hard to pick these turning points. Often you think that you're going to get at 6 o'clock when you're still at 5 o'clock. So we do want to see the upgrades starting to come through. I mean, the banks are a pretty good example. They've been in downgrades for a long time, and they look cheap, and people thought, okay, now it's time to get in, but they continue to have earnings downgrades. It's really when you're starting to see actually the earnings upgrades starting to come through that they can go through a cycle, which can then last a while. Sometimes it's 6 months, sometimes it's a few years. Some companies are in upgrade cycles for close to 10 years. That's really when you have these first few upgrades that you actually really de-risk your investment case for the stock. And so we typically take a smaller position to start with, and as and when that earnings upgrades continues to materialize, we take a bigger position as long as we have confidence that the next one is going to be an earnings upgrade. That also says that when we are invested in a company where suddenly there's an earnings downgrade, we wouldn't be the people doubling up, because typically the earnings downgrade will mean that share price will correct downward. If something goes wrong on a thematic, we typically either exit, or we trim, or sometimes we hold, but we will certainly not double up on the investment. We found that kind of adds far too much risk, and that something has gone in the thesis that needs to be really revisited before getting increased confidence in it.
Okay, great. Thanks for mapping that out for us. So Alphinity's portfolios have really thrived through the pandemic and the volatile times we've seen over the last 18 months. And yeah, I guess we're still seeing now. Why do you think that is? And what are some of the lessons you've learned through that time?
Yeah, I mean, that's been quite a ride since February 2020. I mean, the speed and the intensity of the up and downward corrections has been almost unseen, but the pattern has been quite typical. We've moved from a phase of despair during the early COVID stage, where you had an earnings and PE contraction, to progressively moving towards a hope phase, where you have had a massive PE expansion when the monetary and fiscal stimulus were announced in April, May last year. And eventually we've moved towards a growth phase, where you're seeing the EPS expansion, the earning expansion coming, yet you're having a PE contraction. Basically, the earnings growth is justifying the old PE that you had. And that happened when the vaccine was announced in November and since. So we are in the latter phase of this growth phase, which would mean that from now on we should see lower returns in the stock market, but nevertheless, that is also requiring the earnings growth to come through to continue to be positive. That growth is coming through because we're seeing the manufacturing and the service PMIs really at record highs in the US as well as Australia, and that's translating in this earnings growth that we were hoping for, and the PE has started to contract from 24 times to now less than 18 times. So as you said, the fund has done well. We've managed to get more than 5% alpha over that year. And I think it's been really sticking to the process and remaining nimble during it. And that's really following the earnings leadership. That's all what our process is about, is to invest in companies where we see the greatest potential for positive earnings surprises, and where our factors are showing that the important thing, what we felt, is it's really important in phases which are as volatile, not to try to guess where the macro could change. So for instance, if you believe that the borders would open up pretty quickly, you might have invested in Sydney Airport, and that would have hurt. So we typically see a pattern of leadership. We stay into that. If and when there is a transition of that leadership, which can be quite sudden, normally it's pretty rare in the market, happens only every 5 to 10 years. But when it's happened here, it happened twice. In April 2020, when the stimulus was announced, and then again in November 2020, when the vaccine efficiency was announced, which meant that there was a reopening trade. We then just progressively adjust our portfolio to follow that earnings leadership. We don't try to anticipate too much, but on the other hand, given the volatility, we try to have a bit of positions on both sides of it. If there's an earnings recovery, if there's a reopening, we want to have some positioning, but it would be remaining, we would keep a small position rather taking a big bet on saying, or it's all opening up. So we would kind of really follow the earnings leadership.
Okay. So have you learned any key lessons, or has anything changed in the way you do things in the last?
No, I think, I mean, that following the process was a key thing in having potentially kind of a bit more positions on both sides to kind of mitigate the risks of the macro shifts, but still kind of keeping the skew of the portfolio towards where the earnings leadership is. So that's what we've done, and sticking to it was important, and managed to provide good alpha. Yeah,
great. So what does that look like in practice? What sort of companies and sector allocations have changed, or what are you doing there?
Yeah, I mean, we entered the market in 2020 with a rather defensive portfolio because we saw that the PE had expanded, yet the earnings were not following. And so we were quite cautious when we entered the February reporting season in 2020. We had no energy, we had limited consumer discretionary exposure. So we did well in March last year, but when the stimulus was announced, that's when the rotation started happening, this change of the earnings leadership, shifting from a defensive and growth earnings leadership stocks to far more cyclical and to some extent value stocks, but with more of a at-home focus. So then over the year, as I mentioned, we had the November shift with the announcement of the vaccine. So and that kind of led to a trading opening of the economy. So the shifts we've made over the years, if I look at the big shifts, we've gone from an underweight in banks to overweight in banks. We have lifted the consumer discretionary position through Super Retail Group, Burson. We've also lifted our exposure to construction through James Hardie and CSR. We've maintained our overweight in resources throughout, but with a shift of the emphasis more towards cyclicals like Oz Minerals on the copper side, and also steel names like BlueScope and Sims. And we've reduced the bond proxies over time. We've sold down APA, Transurban. We reduced the tech exposure. We've taken a bigger underweight in the REITs. So really a cyclical shift, yet keeping some positions a little bit on both sides in case if there is a massive macro shift again.
Okay, so some of those changes have been brought about because you were positioned quite conservatively, as you said. So when you talk about being positioned conservatively, what does that look like in your portfolio? Are you holding extra cash, or is it just the types of businesses you're holding?
No, it's more, we don't hold extra cash. We always kind of invest, the maximum holding on the cash, I would say, is 2 to 3%. Our mandate is to invest in equities. It's more based on the market that we are seeing, whether we take on the earnings leadership, if the market is correcting itself downwards, you do go to more defensive stocks, or you're looking for more growth companies, which do give you that kind of earnings growth. But when the market is shifting to a reopening, you tend to go more towards cyclical companies, and that's what we've seen. And so when I mentioned the conservative side was more the former position initially, and I think that over the last few months we've shifted more towards a cyclical bias in the market, and have positioned ourselves accordingly. Okay,
it kind of leads on to, I guess, thinking about conservatism, and the Federal Reserve in the US is becoming a little bit more, I guess, hawkish, and a bit more conservative in their views about what's happening in the environment. What's your take on the sort of macro signals and some of the environment out there, and how that might look for equities?
Yeah, first I'll preface by saying that we pick stocks on a bottom-up perspective, really, rather than a macro, but of course we're very macro aware of what's happening in the sectors. So the Fed has certainly kept us all on the edge in the market. And for a bit of context, the 10-year nominal Treasury bill in the US has moved on from mid-2018 at the level of around 3% to around 0.5% during COVID, with actually real negative rates in terms of -1%. I'm speaking about the nominal bond less the inflation.
Yeah.
Since September, we started to see a rebound in that treasury yield with an acceleration which has lifted the yield to 1.7%. And that was really driven by an expectation of a faster than expected recovery. And also that with the view that the inflation was coming back actually stronger than expected, and that the Fed would sit behind the curve before tapering in lifting interest rates. And the view was that that would only happen in 2024. And that started creating a concern actually that maybe this might get out of control, eventually requiring a more aggressive interest rate cycle afterwards, and more aggressive tapering. So that yield curve started steepening, and that has quite an impact in terms of the market rotation. So we saw a rotation in the market from what we call these defensive in growth, long durations assets, as the tech stocks, the IT stocks, and healthcare stocks. We saw that migration towards much shorter duration sectors and cyclicals, which provided some inflation hedge or exposure to the short-term rebound in the economy. So that's a context aside. When the Fed last week took a more hawkish stance, as you just mentioned, Jeff, announcing that it could raise interest rates earlier than expected because the recovery in employment was faster and stronger than they had expected, and also because some parts of the inflations were actually initially seen as transitory, where actually some parts are actually going to be less transient. We're seeing the rents increasing quite strongly, actually, and that's a big component of the CPI. So the Fed reacted by saying, actually, we might have to bring forward the interest rate raises from what we initially thought would be 2024 to maybe sometime in 2023. And that triggered quite a strong reaction in the market, with the US dollar strengthening and the expectation of inflation maybe getting out of control, unwinding, and the yields started going back down from the 1.7% to 1.45, and back to a shift to growth and some defensive. So, and you saw the commodities being hit quite strongly, and the tech getting a boost. So it keeps the market really on a knife edge on where to go from here. But our view is that over time, the recovery is very strong. And I was just on phone calls with the US this morning, and it's actually very, very strong on the steel side, on the scrap side, and also on other commodities that I'm following. And we believe that will eventually push the yields up. So cyclicals and value still have a very strong role to play in the portfolio. But we are 12 months into this recovery, and that means that quite a lot is factored in, yet we still feel like the earnings leadership is with them. Although that the earnings revision index, which means that it is softening, which means that now less people are upgrading versus downgrading versus a few months ago. So it feels like we are it's very strong, but expectations are getting higher up. So overall, what does it mean for the portfolio? You still want some cyclicals, you still want some banks, some values like in the banks, but you also need some growth names, but high quality growth names. So you need a bit of a portfolio which is composed of both sides of it, and where you see kind of earnings surprise behind that. The tech sector for us is very hard to justify valuation wise, and as we don't see really an earnings growth here, it's a very difficult sector for us to kind of look at. But so we get that very much now through cyclicals, values, and high growth names.
Okay. So that you sort of touched on some of the challenges that are coming through. What other challenges do you see coming up for investors, and how are you sort of facing into those?
Yeah, so yield curve, we touched on that, and then inflation, that's a key challenge. Of course, the other one is the vaccine rollout, and how quickly borders reopen. That's another very important one. For Australia, the geopolitical situation with China is clearly of a concern and something that we're watching, and means that risk adjust our positions. And longer term, not really an issue right now, but there'll be a concern about who repays all this debt and this fiscal stimulus, and how that gets funded eventually, or repaid. So, but short term, the yield curve in COVID is really front of mind.
How do you, I realize that it is longer term, but how do you think about, who's going to repay the debt, and how will that impact portfolios or the companies you might look at?
I mean, it probably is going to be through. If it's through inflation, that's the ideal way that it happens. If the inflation is controlled, but you have that, but it probably will mean a combination of taxes eventually also. So I think it's too early to say that to say exactly how it's going to be done, and because we could be actually at these low interest rates for a while. So yeah, it's something we'll have to kind of think through. Probably not playing directly in our investment decisions for the moment.
Okay. So moving on now, your fund is part of our AAN Sustainable Growth portfolio. So I'd like to just sort of talk a little bit about sustainable investing, which is obviously a growing part of the market, and it seems like there's 10 new stories about sustainable investing every day. Maybe it's just what Facebook and Google are serving up to me, but I think it's probably most other people are seeing it as well. So it's a massively growing space. What's driving that, and how is it changing the marketplace for you?
It's huge, and it's, I mean, the amount of dollars which has grown into it is significant, but and COVID has turbocharged it. I mean, clearly the global pandemic has raised global issues that society has to deal with as a society, not only isolated, but kind of around the world. And so that meant also we need to do the same on climate change and other aspects. And so it's lifted to some extent almost like a human consciousness in the urgency to deal with sustainable issues. And it's incredible, Jeff, how we've seen that over the last 2 years in terms of questions we're getting from clients, which are far more specific in terms of ESG and engagements that we're having. We actively engage with a lot of companies. But the level of details from the clients has really increased, and most of our clients are institutional clients. But the level of engagement with companies has also changed quite a lot. We spend far more time with CEOs and chairpeople and sustainability teams which have been established in companies, speaking about how they decarbonize, how they look at this supply chain or supply chain in terms of modern slavery or aspects like that. And there is also far more cooperation between fund managers on big issues such as diversity, climate change, and or controversies which could hit a company. So eventually, that one believes it or not, all this actually really starts to affect the fundamentals of demand supply for companies. We've started seeing that a few years ago in terms of thermal coal. Would have been very difficult for new thermal coal mine to be funded. And now that's starting to spread to the whole oil and gas sector, which, by the way, this fund doesn't hold. But you can see companies like Oil Search, who have an asset in Alaska, an oil asset, they're struggling to sell it because very few listed buyers would be able to do that, as it would raise ESG concerns. So it's actually really starting to drive the funding well to the oil and gas companies, and starting to change the cost of capital. You can see the cost of capital really being affected when you look at a Shell versus a Tesla. But on the other hand, it creates tailwinds for some other industries. Whoever is exposed to the wave of cleaner solutions, in whatever form they are. If you look at electrifications, renewable electric vehicles, Australia will certainly benefit from lithium, copper, in all these different kind of demand lift, which affects these commodities, but also it can be across the value chain or the manufacturers. So there is a demand impact and the cost of capital impact that cannot be neglected actually from now on.
Yeah, absolutely. So you touched on a few interesting things there. I know, everybody thinks about sustainable investing and ESG quite differently. Different fund managers we've talked to a few already in our sort of series. So how do you and Alphinity kind of interpret?
That's a great question, because you're absolutely right. There are many terms out there and many interpretations of what sustainability means, or ESG mean, or socially responsible investment means. So different views, and I think what is really important is to be transparent of what the fund does and what the fund doesn't do, and what they support or don't support. So transparency of what one does is really key. The RIA, which is the Responsible Investment Association of Australia classification, they've come up with a classification of the spectrum of sustainable investment types, and we'll point to it in the presentation we'll send after this discussion. But on the left-hand side of it, it will show that its most basic form, it starts with ESG integration. So that's kind of a risk management approach, really checking that, or making sure that the company has a social license to operate from its employees, from the government, from all its stakeholders, and it treats stakeholders in an environment in a good way, so that you don't have a reputation blow up. That's at the very basic what any fund manager would do. We have that, of course, as part of the fundamental assessment of company across all our funds, not only the sustainable fund. That's really, for us, part of the fundamental assessment of a company.
Yeah.
On the other spectrum, other extreme of the spectrum, you have philanthropic investment, where one really cares about having a positive impact on society, and on sometimes something very specific on water management or hunger, but probably with less consideration to investment returns. Our sustainable share fund is sitting in between these two. So it goes clearly one step beyond ESG. It takes a values approach to investing, but it also makes sure that we have good investment returns. Mm-hmm. And so we invest in companies that not only have a good ESG practice, but also offer services and products that do good to society. And how we've anchored the notion of doing good, we've anchored it around a framework. I think it's important to do that, because it takes a lot of the subjectivity away. So we've anchored it around the 17 United Nations Sustainable Development Goals, which has become more and more a recognized framework for sustainability. And it's trying to address grand goals like reducing poverty, improving healthcare, improving education, addressing climate change, and many of these goals. So that takes some of the subjectivity away, but you still kind of have gray areas. So our fund goes through a three-step process. The first one is to define the sustainable investment universe. And for that, we've developed a rigorous and systematic framework to analyze the company's contribution towards these sustainable development goals, looking both at the positive and negative alignment, which is important to look at both sides of it. We do that in-house, so we have a strong view on the narratives of the companies. Once that is done, the second step is to pass these contenders through our sustainability committee. And that committee is comprised of 2 external experts, which are actually really highly reputed, in addition to 2 PMs. And the role of that committee is to debate the gray areas and ensure that the universe always stays true to the charter of the fund, so that we kind of always make sure that we have companies that we feel really strongly about the sustainable development goal side. And engage also defines an engagement agenda with the companies where needed to shape and hopefully influence practices. The third step is really important, is once you have an investment which has been passing our committee and has been approved as part of as being investable, then we apply our Alphinity investment process. So the engine of looking for earnings surprises and finding these companies in it. And that's really key, because investing in, there are some very sustainable companies out there which are very poor investments. So we really need to make sure that we do find the right ones. And this allows us to build a portfolio of companies that contribute to society positively, but also hopefully contribute to our client returns positively too.
Fantastic.
Long answer, sorry for that.
That's a very, very thorough and rigorous process, but that's, I think that's what we expect. And that's, certainly part of the reason that from an AAN viewpoint, we're really comfortable and confident in adding Alphinity into the sustainable growth model, because it is important that we know, the framework, and that it is a repeatable and sustainable sort of model within itself. I guess an interesting part of that is, focusing on the Australian economy. It's quite a concentrated market. Has often been referred to as a hole in the ground surrounded by a few banks. So, very much banking and mining sector sort of focus. And I think a lot of people would say the banking and mining sectors aren't always what you think of first when you think about ESG and those ethical investing. So how does Alphinity think about that, and how does your investable universe maybe, take that into account?
Fair enough, and a good question again. I mean, we do focus on companies that do good and are part of the solution. So, but no, we'll speak a bit about the exclusion and looking at the bank and the mining sector. So what we do exclude is we exclude fossil fuels. So that's thermal coal, but also all oil and gas producers and users. We exclude addictions like tobacco, alcohol, gambling. But the fossil fuel means exclusion means that we do exclude 8 of the top 10 carbon emitters. And that means that the footprint of our portfolio will always be well below the index. But it comes with its challenges also, because you exclude companies like BHP and all the oil and gas producers. So we exclude around 23% of the index. Mm-hmm. In terms of the mining side, we've thought long and hard about this, and we've taken a principled approach to the commodity that is being extracted, and really looking at the commodity by commodity and thinking through whether this commodity is required for a sustainable world or if it's not. So if you take, for instance, copper is really required if we want to have electric vehicles, if we want to have wind farms, if we want to have batteries. You can't have them without copper. Same for lithium, same for nickel, same for cobalt. But then you do really pay attention to the way these commodities are extracted. So the ESG component of all the practices on how the extraction is operated by the companies is really critical. We've excluded gold, for instance, because when you look at gold, it has very little value added to society in terms of sustainability. It's mainly used for jewelry. It's mainly used for a storage of wealth. So nothing which kind of really adds value to society as such, except that it comes with a pretty large footprint, so environmental footprint. So we've taken gold out. In terms of the banks, it's a tough one, but when you look at the fundamental role of the banks, it has 2 roles. It has the utility style role, and then it has the investment style role. The utility is really important for households and for enterprises to get access to funding, to be able to invest in projects that do good, or to be able to buy a house and so on. So we're really looking at the book of the loan book of the banks. And we try to prefer the banks which have more debt exposure than the ones which have more speculative exposure. So that's the way that we look at it. Okay.
So yeah, I think it's interesting how you sort of drill in commodity by commodity, and then bank by bank, and look at it, not take a view on the sector, and it makes a lot of sense to me as you outline that there. We've got about 5 minutes to go, so I just wanted to put it out there. If anyone has any questions, now would be a good time to get typing, and we'll have some time to get to those. I guess whilst we're waiting to see if any other questions pop up, one of the main concerns we often hear about ESG investing is it might be, because you've got a smaller universe or constrained environment, you might be taking higher risk, or you might have to expect lower returns. And sometimes there are more costs associated with that as well. So what's your experience and views on how that plays out?
Sure. I mean, it's a pretty common belief that investing in sustainable companies or socially responsible companies, whatever way it's named, comes with higher risk and lower returns. But actually, our experience, we've done it now for 11 years. We've been able to deliver, I think since inception, 3% alpha per annum, and over the last 5 years, 5%, with an information ratio of 1.2, which means we're really getting a good reward for the risk that we're taking. The worst financial year we've had is an alpha, so basically the difference versus the market performance in our performance, a detraction of 70 bips, so 0.7%, and the best year has been 8% alpha. No doubt that constraining the investment universe makes it harder to invest. We could not invest in staples like Woolworth or gold when the market went into contraction, for instance, during COVID. Nor could we invest in energy or gamblers when the market reopened. So yes, it does create some constraints, but they seem to kind of match each other out over time. When we look at the exclusion costs, looking at all of them together, over the last 1 to 3 years, it's been pretty minimal. And at the end of the day, we really believe that it's really a question of stock picking that is important, is to find the companies where you have these earnings surprises. And yeah, as long as you manage to find that across cycles, you should be doing well. Makes sense.
So I've got maybe one final question to wrap up. We've got one question that's come through as well, which is similar to what I had in mind. How do you expect ESG investing to change? What sort of changes have you seen, and how do you expect it to change over the medium term or long term?
Yeah, I mean, I think the momentum is just accelerating here, and I think it's going to become bigger and bigger. And whatever we had on the spectrum of what I was mentioning earlier on ESG being the risk management approach, I think it will start moving more towards the right-hand side and look more at almost capital stewardship of really going and influencing companies. So I think you'll get a wider choice of sustainable products across the market, across asset classes, and within asset classes like a green property or green private equity or company funds going for specific SDGs, sustainable development goals. I think the shift in allocation of capital is just accelerating away from problems to solutions, and so therefore there'll be a huge tailwinds for sustainable companies. I think still doesn't mean that the fund will outperform. You will still have to find the companies which are benefiting within that and have earnings upgrades. I think the conversations with the companies will change also, from our clients to us to the companies. Like for instance, when you look at a company like Westpharma today, you ask a few questions about what's happening in terms of the modern slavery across the value chain when they source Burnix or Target or Kmart from different sources around the world. I think we'll want to see more evidence that all the audits are put in place to make sure that there is no modern slavery across the value chain. There'll be the level of detail of questions will be one level beyond what we're having now, or the evidence that we will want to see. We will want to see far more concrete plans in terms of decarbonization, not only net zero targets for 2050, but it's actual solutions for making it happen. And they'll be monitored, and that will play in investor minds. Increased transparency potentially increased global frameworks, which will make it easier to kind of really assess a company that is sustainable versus less. But there will always be gray areas, and that's where I think you always need to have an in-house ESG team to actually, with the analyst, look at the company and think through the issues at hand and engage with the company. For me, the active management is hugely important in this space, because you do really need to go through and think through these areas of gray areas with the companies.
Yeah, I think that really comes through with at an investor level and at our level in terms of choosing the companies to partner with as well. With the explosion in people talking about ESG investing and the growth of funds going in there, the risk of, I guess, surface level treatment of some of these issues, or so-called greenwashing maybe increases, and that's a hard one for investors to really overcome, which is where I think it's important to look under the hood and see what's happening behind the scenes. What are their credentials? How have they adjusted to changes in expectations in the market, which is some of the things that you're already flagging that Alphinity
absolutely
is making good sense of. So in wrapping up, is there anything that you suggest investors might look for as they start looking at ESG options, or
transparency of what people offer, what they do stand for, what they stand against for. We have a charter, it's very clear, it's on our website. We push our thinking through the different sectors. Evidence of engagement, what engagements have happened, what was the purpose of the engagement, what did the engagement create, and of course eventually congruence between the stocks that the investor is holding versus the charter. That's also very, very important, that it aligns with what we're trying to get.
Makes a lot of sense. That's great. Well, we're right on time, so we've nailed the timing there, Stephane. So well done.
Thanks very much, Jeff.
Thank you very much for your insights and sharing a bit about the Alphinity story and how we can go about tackling the next investment challenges that are coming up. Really appreciate your time. And for everybody home, thank you for your time as well. And
thank you to everybody. Yep. Thank
you.
you.
Stay safe, everybody. Thanks a lot. Bye.
Bye-bye.